Welcome to the State of the Markets podcast. I'm Paul Rodriguez of ThinkTrading.com.
I'm Tim Price of PriceValuePartners.com.
And our very special returning guest is David Hunter. Dave Hunter, welcome back to the show.
Yeah, hi Paul, how are you?
Yeah, brilliant, thank you. And doesn't time fly? I was just looking back at when we were last on, and we last had you on Valentine's Day 2024, which is amazing.
Wow.
Before we actually go into the interview, I want to invert things slightly, because at the end we normally talk about handles, and I thought it's really important to say right at the start, because you've got now over 200,000 followers, a lot of people kind of imitate you and pretend to be you, and a lot of the discourse you have is via Twitter. So your handle is Dave H. Contrarian. So the name Hunter's not actually even in there. So Dave H. Contrarian. So for anyone who wants to follow you, you've got over 200,000 followers and rising. So it was 196,000 when we first started speaking.
Really?
So obviously doing something right.
It's the State of the Markets boost, the inevitable boost effect.
Yeah, I think there's a bull market in me for now anyway.
Well, absolutely. There is definitely a bull market in you, and there's a good reason for that. And you were making some what would market terms be called very aggressive calls, very confident calls, and they've pretty much all come right. I think the only thing that maybe didn't quite go your way was the 10-year bond yield that you were looking potentially would come a bit lower, maybe the dollar. But you actually talked about the dollar going up as well, and some factors that would confound that a little bit. But you were absolutely spot on with the direction of the market, with the aggression of it as well, which is quite amazing, really. So people, I think private investors, amateur investors, don't really realize how hard it is to get this stuff right. And when you do get it right, you should get the praise for it.
Yeah, it's amazing. I get beat up for timing because I want it to happen in some precise time frame, and I'll make the mistake of saying it could happen by this time or whatever, and it always takes longer. But what they don't stop and look at is that for 90% of the pundits out there, they didn't get the direction right. Never mind, I got the magnitude and I got the direction. Sure, it's taken longer, but that's the nature of bull markets. They stretch out.
Yeah, I have an expression: amateurs look for absolute precision, and professionals understand that there's risk, that things change. Your outlook could change because of certain factors that you're looking for. Maybe they all come together, maybe only a few, and you have to be flexible with these things. But in terms of your bullish calls, are you still bullish? Let actually, before we do that, I'm going to say what you said at the time and where the markets were, just to give people an idea of how good the calls were. So the S&P was at 5,000 when you called it. You said you were looking for 7,000. Obviously, it's now at 6,000, which was an amazing call. Obviously, because people were very, very bearish at the time, and probably still are now. The Dow was at 38,424. It's now at 44,421, and you were calling for 55,000. The Russell, everybody hated the Russell. Oh my God, I couldn't find anyone who liked the Russell. You were bullish on it, calling for 3,300. It's at 2,258, so it's gone up, which was more than anyone else expected. And the Nasdaq was at 18,000. You called for 23,000, and it hit 22,000. It's now at 21,297 because of the volatility. Gold, you said, was going to take off, and actually gold had come off a bit and looked sort of like it was in a consolidation. You were like, no, this is going for 3,000, and it's now 2,833 and accelerating. Silver was at 22. It's now at 31, and your target was 60. All those are fabulous. So that's really shooting the lights out.
Yeah, I will. The only one I would correct you is the Nasdaq. People get mixed up because I use the Nasdaq Composite,
Oh,
so
okay.
not the NDX.
Okay.
So it's not quite that high, but it is 19 and change. and my target was 23. I've raised that to 25,000. I've raised my S&P target to 7,500. My Dow and Russell targets are still at 55,000 and 3,300 respectively. But I'm still extremely bullish. I think there's a final leg into a top coming this year. Um, Short term, I'm actually probably more bearish than the market is today. I think doesn't have to, but I think there's a decent chance we see a 3 to 6% correction, or depending on the index, in the next week or so. The Nasdaq, I wouldn't be surprised to see that get down to somewhere around 18,000, 18,400. The S&P could get down to 2,800, 2,840. So, when you do the numbers, it's, 3% on the S&P, maybe 6 on the Nasdaq. So we're not done. We've really kind of topped out in the market in early to mid December. And I think we're just more of the same high level consolidation here. You get people who want to see this stuff go in a straight line. It's going to frustrate them, but it's just a normal consolidation. We had a great run, as you just pointed out, and it's not unusual to have a couple months where you're backing and filling, and yet, I mean, I couldn't be more bullish. I think there's still a big upside.
So the Trump 2.0 administration and the tariffs don't really change your fundamental orientation towards markets. Would that be fair?
Yes, in fact, I think what Trump's doing is absolutely right. It's pro-growth policy. You saw yesterday. I mean, people are not going to understand that. I keep saying, I use the phrase a lot. Let it play out, about the markets, about the tariffs, etc., because people want to do instant analysis on things that may be very short term, as we saw with the tariffs. He uses a lot of things for leverage to get what he wants, and yet the street wants to go around and look at what he's proposing as permanent, and you just can't do that with him. And frankly, you shouldn't do it with anything. You gotta let things kind of play out and not try to do very fast analysis on everything.
But do you think there's any risk that we get plunged into a sort of tit for tat tariff world that echoes the 1930s?
It's certainly a risk. I think what people underestimate with Trump is he understands when he has the leverage. For example, with Mexico and Canada, he just knew that they can't afford to do tit for tat.
Mm.
They want to talk a tough game, but in reality, they know that in the end, their markets are less important to us as a percentage of our whole than we are to them. And that's what he basically using leverage. Now, there will be places like in China and Europe where he's going to try to level the playing field some. We've been the market to the world. And we have a new sheriff in town saying we're not going to just hand our markets over to everybody. It's time to bring production back on shore, and it's time to even out some of these markets. So there are going to be some times when it's a little sticky and unfriendly to the markets, but by and large, I agree with what he's doing.
Do you think it's at all likely that the Department of Government Efficiency will be able to make a meaningful dent in the debt or the deficit?
I do. I mean, what's amazing about
Because
Trump
it's a
2.0,
huge problem. At the scale of it, it's like the Augean stables, so it's a non-trivial exercise.
it's a non-trivial exercise, but that's why when you see them go in, even though USAID is a relatively small part of the budget, when you see them go in and lock the doors, lock people out, and say we're doing an audit, we're going through the numbers here because too much money's been kind of just passed out to favored constituencies around the world. Um, that's a sign. They Trump has had 4 years to think about this, and it's not just Trump. He's got good people around him. They mean to change business as usual, and I do think it's not going to be $2 trillion coming out of the budget, et cetera. but I do think you're going to see big efficiencies. You're going to see things done more like a business, and I think the markets will respond to that.
I mean, that would tend to suggest then that the strength in the dollar is sustained. Do you have a view on the dollar?
Yeah, well, the thing is, there's on the one hand, which is Trump and Trump's agenda, and then there's on the other hand the macro, as I say, the macro trumps Trump. We are in a cycle. We're in a super cycle where we're coming to the last decade of a super cycle. We're in a situation where I think there is an awful lot of, my global bust forecast following the melt up still exists. I still believe before the end of this year, we're going to be in a global bust. But it has nothing, it has little to do with Trump's policies. It's really something that's been building up for decades.
Mm.
And, I think the pandemic made it more difficult for the central banks to understand the risks. The pandemic basically stretched out the cycle. So they're still worried about inflation when I think deflation is the coming risk. So there's those things out there that I think is going to turn things the other way. Um, but you've got, in the short run, you've got good news coming from Trump, I think. But in the end, yeah, I think there's some real risks out there.
Are you saying this super cycle actually started?
I define a super cycle as the long cycle between two depressions. So the 1930s was the last Great Depression, and the 2030s is probably the next depression. So we're in the last decade. The global bust will feel like a depression, but that's not the depression because we have the printing press. We'll print our way out of this one. The problem is it will create the opposite effect. We'll be dealing with a deflationary bust in the next year, I believe, and they will print like they've never printed before, and it's that money that will cause the last recovery cycle, but it'll be a recovery cycle that's driven by double-digit inflation and industrial. So by the time we get to the early 2030s, I think you could be looking at 25% inflation in this country.
Wow.
So and if you have 25% inflation, and right now we have 320 trillion in global debt. By the time we get to the end of the decade, we could be looking at something north of 400 or 450 trillion. You have that combined with inflation in high double digits, and interest rates will match inflation or will track inflation. You can't solve that puzzle, and you collapse.
That suggests that bond investors are going to get eviscerated.
Yeah, bonds. I am calling for a 0% 10-year this year. So by the end of this year, I think you could see a 0% 10-year, because part of it is because we're heading towards deflation, but a big part of it is if we get this global deflationary bust, I'm predicting the central bank, the Fed, just the Fed itself, may have to push out 20 trillion in new money in QE. That means buying up every bond in sight, right? To do that. So you will drive rates to the floor. And the reason you're doing it is because you got free falling financial system around the world. It's 2008-9 on steroids. And so you get one last push to rates down to zero and short rates to negative. And then you begin at post bust, the beginning of the biggest bear market in bonds you've ever seen, because you'll go from 0 to 20% interest rates. So I would say, yeah, post bust, you don't want to own a bond. You'll be if you're running a portfolio, your fixed income portion of your portfolio post bust will be rolling T-bills. I mean, that would be what I would do, because every 3 to 6 months you can refresh the rate at a higher rate.
So as of today, would you want to buy bonds just because yields may go down anyway, and then you'll be holding it into the potential crash?
Yeah, treasury bonds for sure.
Yeah.
Corporates have some run here along with the equity market. So for the next, 3 to 6 months, you can probably own, both corporates and treasuries. But as we move closer to the bust, you'll only want to be in government guarantees. and then hold that through the. I think treasuries will be one of the very few assets to hold up in the bust.
So, what will be the signs that you're looking for to show us that these cracks are appearing? Because as we know, these shearing of the markets can take quite some time, and surprisingly, the markets can hold up a long time as well
Yep.
in those periods.
Yeah, I say 3 to 6 months probably is my expectation for the equity market, but I've been saying this for a while, so it doesn't mean it can't go longer than that. I think what you'll see as you approach the top in the equity market is everybody will be all in. You know, all the skepticism that's been there from October 2022 and before will be gone, and you'll have people talking about number one, Trump 2.0. The agenda is pro growth. Number two, it looks like the cycle can stretch, that we may be beginning a new cycle that can last for many years. Inflation, in my opinion, is not our concern right now. We're probably going to see inflation rolling over here and heading to the Fed's target and below. So people are going to feel good that the Fed actually did its job and beat inflation. So you're going to have kind of a cake and eat it too, where you feel like earnings are in good shape. The economy seemingly is slow growth, but in decent shape, and inflation's in good shape, and interest rates are heading lower. All of that, I think, will be the narrative near the top. The hardest part is when things look that good to realize that's probably the time to step out.
Oh, absolutely. I mean, obviously, your handle says everything about your way of approaching the markets, being a contrarian, and it's something that if you're in the markets long enough, you see enough cycles, you know what it's like at the top. 1987, how bullish everybody was. The dot-com boom's a classic example. 2007, just before everyone buying houses and everyone making tons of money, and how it was just looked like the party would never stop. And obviously, there's been a lot of skepticism along the way since then because the system has not been fixed and the can has been kicked down the road. But here we are with that skepticism still there. And it's something, perhaps Trump is the key to all of this, because people will then really start to believe, and he will probably start to believe that he's kind of fixed the markets. He's got that secret ingredient that will only make it ever go up. And then, you'll be saying, right, that's it. And the warning bells will be going off.
Yeah, it's interesting because obviously you go back to October 2022 and everybody was bearish and sure we were going to 3,000 or below on the S&P, and you're going to have the exact opposite of that at 7,500 or 8,000, wherever the S&P goes to, and those people which I think much of Wall Street is in this camp, who really don't think Trump knows a lot. They are skeptical of Trump. They think he's all talk and all that. I mean, they are understanding that he's coming in with a pro-growth agenda, but they're only slowly warming up to him. For the last year, they really didn't think Trump was a bullish story. I think by the time we get to the top, and again, maybe within 6 months, you're going to have a lot more people on his bandwagon. And yet, there are flaws in what we're doing.
Tim, I don't want to hog the mic. Do you?
I, 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 I mean, I certainly agree. Trump is a consummate deal maker, and I get the sense that he's acting a bit like a wrecking ball, and we'll see what's left standing at the end of the day. And I think I'm inherently supportive of what he does. I do get the sense though that there's a lot of contradictions in policy. So he says he's stated something along the lines of a commitment to a strong dollar, but he also supports cryptocurrency. He's issued his own meme coins. So he seems to be a sponsor of cryptocurrency, which is incompatible with supporting the dollar in any case. But also, I can't see how he can have a strong dollar and be pro-growth and want to export, et cetera, et cetera, et cetera. And interest rates are probably going to have to be cut. So there seems to be a kind of like jumble of logic to some of the big policy aims.
Or there's a misunderstanding, because I think his Treasury Secretary is looking for a lower dollar. I don't think they want it this strong. So I think generally he's
You have to
supportive
sort of
of
read between the lines on what he says about the dollar, effectively.
yeah, I think generally they're supportive of a strong dollar, and certainly they want to see the dollar be the reserve currency of the world.
But they wouldn't mind if it softened.
But I think they also understand transactionally that it's if we want to get trade more balanced, the dollar has to come down. So
Sure.
I have and have had for quite some time a very bearish dollar call. I'm looking for 82 on the dollar. Between now and the early part of the bust, it will probably be weakening into the early stages of the bust. Later in the bust, I think the dollar gets a bid as people flee to safety. But early on, I think you could see the dollar go from 108 today down to 82, which is a huge drop. And I'm calling for the British pound to rise to 130 versus the dollar.
I'm surprised that the DeepSeek announcement hasn't had more of a lasting impact, say on your forecast for the medium term. Does that not sort of put a real set of bullets into the sort of the AI narrative?
Yeah, I think it could. I mean, certainly it's going to you have to wonder about the stranglehold that Nvidia's had on the whole AI thing and stuff. I think what it is that something like that is in a more compressed way, kind of more evolutionary than the street wants everything to be revolutionary, like it's going to change everything today. I think most of the big companies ordering chips aren't going to, I don't think they're changing their orders or doing any of that based on that. But over a longer period of time, it does tell you that this thing's going to start broadening out, and there's going to be a bit of a democratization of AI.
So you're saying you think that inflation will come down. Is that partly because the dollar's been strong?
Partly, but I think it's really, and again, it's one of those things where we have to wait and see. But I believe that, and I mentioned before, I feel like the pandemic really made it harder for the central banks. I believe that what we had, we shut down the world government, basically world economy back in 2020, and then pumped everything up to get us out of there. All that money that was pumped, and again, I'll just focus on the Fed. The Fed's balance sheet in 2008, going into the financial crisis, was 875 billion, and then we kind of grew up by another 3 trillion over the course of the next decade. It blew up another 5 trillion to 9 trillion in response to the pandemic. I mean, these numbers are so far beyond anything we've seen in history. And that's what I mean by saying we're at the end of a super cycle where these things get way out of control. I think that money's sloshing around, and is why we haven't seen a recession already. Thought we were going to have it 2 years ago, et cetera. It's there's lots of micro reasons you can look at, but basically, the central banks are worried about inflation when, in fact, as that money's being used up over a course of 5 years, they're all of a sudden going to find out that they're pursuing a very restrictive policy that is going to, because of leads and lags, before they know it, they went too far and things are heading south, and they're going to have a deer in headlights moment because of leverage in the system. We've got 320 trillion, as I mentioned, in global debt. We've got quadrillions in notional value of derivatives. That's massive leverage on the system, far beyond what we had in 2008-9. And I just think the biggest thing is going to push inflation into deflation is that leverage. That if the central banks are moving too slow in understanding we're deflating, not inflating, there's going to come a kind of a moment in time when they're going to wake up and go, oh my gosh, things are really going the other way, and you're going to have to start responding to that. But at the same time, because of 2008 and everything that's happened since in terms of monetary expansion, we have Powell saying, and pretty much Lagarde saying, we don't want to go back there again. We're not going to return to, blowing up the balance sheet and printing money like crazy just to, just to help the markets or whatever. That means when the time is there, where at the moment of truth, when things are starting to head south, our central banks are going to be cautious and saying, yeah, but we don't want to do what we did last time. And so there's going to be a delayed response. At some point, they'll wake up and say, we don't have a choice. But that delay, and because they don't want to repeat the mistakes of the last cycle, is going to cause things to really get out of hand on the downside. So I think it all plays out over, the next year. And it's some of it's going to come fast and furious, and other pieces of it, we're kind of moving towards it slowly.
We've seen a blizzard of. Go on, Paul.
Oh, sorry, just on that point, isn't it what happened in 1929 when the Fed didn't want to cut rates, they didn't want to support the market, and they actually elongated the depression, or they caused whichever way you look at it, caused the depression. So they're actually, ironically, repeating the mistake of 100 years prior by trying to not repeat a more recent mistake. Amazing how that would.
It's funny how they say history rhymes, doesn't repeat exactly, but there's a lot of things that you can learn from history because it does seem to come back around each time.
Sorry, Tim.
I was just going to say that we've seen a blizzard of executive orders, and I think most people are sort of like pausing for breath to try and get a sense of to catch up with reality. Do you think, given the scale and the scope of what the new administration is doing, there is any possibility that Trump is also willing to take on moneyed interests by way potentially of resetting a system without central banks involved?
Yeah, I don't think so. Or if he wants to, there's no way it's going to happen. Because
crypto itself is not consistent with central banking because it's a sort of non-government money.
Exactly. Yeah. And even trying to do something. Yeah, I mean, he has obviously sworn off of central bank digital currency, so we aren't going to see that. But which is more opposite of what you're asking. But yeah, I think you see the Austrian camp out there pushing the idea that we got central banks are bad and we'd be better off without them, or at the very least, this whole idea of going back on a gold standard. And I have said consistently for a number of years, given where we're at in the super cycle, given the scenario I just laid out, it would be
it's Armageddon. It's like Armageddon.
Yeah, it would be suicide if we went on the gold standard, because the only thing that's going to pull us out of that trough, out of that nosediving trough, is going to be money. I'm not endorsing it. I'm not saying it doesn't lead to something far worse, but reality is, if your hands were tied and you said, we just got to let this thing play its course, and we got discipline now in the central banks because of gold, etc., we'd all be living in caves. I mean, it's not the time. If this were done 30 years ago, I'd be all for it.
But it sounds like you'd be basically sympathetic to the argument that there's maybe a reset involving gold being repriced then.
Yeah, for sure. I think gold's going through the roof. I mean, I've raised my 3,000 target to 3,400 for the pre-bust period, between now and the bust. I've got a $20,000 number for early next decade. I've got silver going to 75 now, be pre-bust this year.
Oh, wow.
And silver going to 500 by the early 30s. So yeah, I think the precious metals are. It's been a long time coming for silver, but I think they're just waking up.
Because silver's the thing I was keen to ask about, because although there seems to be a run on physical gold at the moment that impacts in London and Canada and possibly other jurisdictions, there seems to be an even more powerful run on physical silver. And there does seem to be a lot of evidence now the bullion banks are basically short this stuff, and there's going to be the mother of all squeezes in the not too distant future as people race to try and cover their liabilities.
Yeah, I know that story's out there, and I know there's been a lot of talk for at least a couple of years and maybe longer about the big banks manipulating silver and keeping it under wraps, etc. They're not going to be able to do that for much longer if they have been doing that. it. And the thing is, it's in the supply demand situation for silver is very strong, very bullish. So I'm not sure why anybody would think they could hold it down for that long. And particularly if gold gets going, silver becomes poor man's gold. So you'll have that plus the industrial demand that comes from EV, etc.
Can hear the world's smallest violin playing just for the bullion banks as we speak.
Absolutely.
So, in terms of sentiment and looking at gold and silver, could obviously I don't subscribe to this argument, but could one say that maybe the fundamental views that are now coming out and in the paper, could they create a short-term top, a pause in this view? Because it seems like the market is getting going, and usually the news flow doesn't actually match what the market's doing. In other words, it's a contrary call to say perhaps we should be bearish here. Technically, it doesn't look like that. I don't think so. But I'm just wondering, is this a bit of a warning sign that we could be near perhaps a short-term top?
If it is, I'll be wrong because I am bullish, as bullish as I can be. I think gold is breaking out. I think silver is about to get going. It's really, people don't understand. People are very disappointed with the miners because they haven't tracked the metals, but silver itself gets beat up, and people think it's done nothing. But silver was, back at 22 less than a year ago, and was in the teens not long before that, and we're 32, and I think very quickly going to be up in the mid 40s. So I just don't think people realize, because they're so used to silver not doing what they wanted. I just don't think they realize I think the picture is very pretty in terms of a bullish chart, and gold obviously has been ahead of that, but I don't see anything there that causes me pause. Like I said, I could be wrong, but I'm thinking this thing's just getting ready.
Yeah, the fact that people, I mean, there's no talk about it on the street, really. I mean, there's no major sentiment indicators. The only thing that I looked out for in the 2011 top was that there was a lot of adverts for buying gold and sell your gold here and all that sort of stuff. You had it in lots of different places, and I was traveling in Poland by a company that had actually they made their money. They bought this airline, and this airline was effectively funded by gold sales, and it was very rare to have this particular airline in doing internal flights in Poland, which then went bust because the price went down. So the big signals aren't there for sure. And it's certainly technically, as Tim and I have been discussing as well in between our pod with you, that things have been looking really bullish. Obviously, it's been Tim's kind of core strategy for a very long time, but now it really feels like things are getting going. Now, I know in previous interviews that you've done, you've said that it's gold and silver that you're interested in, and platinum and palladium you're not so interested in. But I just wonder what you think now, because I'm looking at a chart of platinum and palladium, mainly more palladium actually, and that looks like it's basing out. And I think we could get a sympathy rally with both of those as well.
Yeah, I wouldn't disagree. I just don't follow them closely, so I don't have real opinions on them. Yeah, I would think they probably do have sympathy rallies, and even copper. I am probably the bull on copper out there. I'm calling for $6 copper. Currently 430 or whatever it is.
430. Yeah.
And I think it really looks good, and has not really moved. So it had run up to 5 and then has been consolidating for several months, and I think it's ready to go again, or pretty close to ready. So I think the next 3 to 6 months in copper looks awfully good.
I mean, that's good for the global economy in the short term, isn't it? Because it shows that there's a lot of demand. And we're also seeing the Hong Kong stock market is starting to round out and turn higher. The Chinese stock market has confounded a lot of bears from 2 years ago, saying that we're in deflation, and that's gone against their views there. But so there is demand coming, and and these to me just put the picture together of more of what you're talking about here, that there will be this feeling that the market is invincible because you've got all the major powers stock market's doing really well and trade is doing really well and the dollar's weak, inflation seems to be under control. What could possibly go wrong would be the question.
Yep, and I do think it's a time to really realize that linear thinking will get you in trouble. You know,
Yeah.
if you think everything is a straight line, think again, because it's exactly that. Just at the time when everything looks like it's in great shape, things are becoming the other way.
Aluminium, have you looked at a chart of that? Because that is looking more bullish than
Yeah,
copper.
I think aluminum looks good too. It looks to me, when I look at XLB, which is the basic materials ETF, it looks to me that like that has less downside risk than the rest of the market here short term. I'm looking for, as I said, 3 to 6% correction. So it looks like that has maybe 3, but less than that maybe, and a lot of upside. I mean, I'm looking for COPX, which is the copper producer, to go to 75. XLB, I'm trying to think what my XLB target was. Hold on a second. XLB, I have a 150 target on it. So, I think that one can give you a pretty good move here. Where is it now? I think it can correct 89? Back. Yeah, correct back to 84, say, and from 84 go to 150. That's a big move.
So in terms of the elements that are maybe showing some signs of cracking, looking at the house builders in the US, they have come off, haven't they? They've come off pretty hard. And either this is another buy point where we'll get another leg up. Well, I guess obviously either they're going to go down or go up. So I'm not saying anything radical there, but I don't like the pace at which they've fallen. What would you say to that?
Yeah, I think you're right on. I looked at them this morning. I kind of go through my different sectors to kind of see what they look like. I'm not sure it's going to do this, but there's a possibility of a double-digit decline in XHB, which is the home builder ETF, here short term. So if the market pulls back 5%, and that does double or even maybe more than double that will be a surprise to people. But I think it is the case. You've got a 7% 30-year fixed rate mortgage in this country. The rates have been holding housing back. There, you saw some activity late last year and into January of people who I think decided, hey, rates are heading higher, not lower. I better buy now because it's only going to get worse. So some of that pent up demand of people who held back because rates moved up, kind of when rates came in a little bit from that, the 10-year went up to 480 and came back down to 450 or a little below. I think that caused the realtors probably called all their people sitting on the fence and say, oh, you better buy now, So you got a little activity there. But frankly, housing peaked, I think, a year or two ago. And, it's going to roll over hard in the bust. I've been saying that if you get a rally in bonds, drop in rates here, that you could get a spring bounce in housing. And I think that's still possible. But I think in the very near term, the next couple of weeks, the home builders look like they could be vulnerable here, and come down 10% or more.
I think it was 2005 that the home builders had topped out ahead of the crisis. So this is what I'm saying about there's this.
Yep, it's an early cycle thing because it's so interest rate driven. But interestingly, because I think we are moving, I'm bullish at bonds, although I think they may correct here for a little bit with stock market. But ultimately, in the next 6 months, I think you could see the 10-year down below 3%. And if you get that, you'll get the mortgage rate down under 6 or maybe 5.5. So you could get one last kind of splurge of people who think they missed it and they're glad rates are down again and jumping in. But it's not, you're not going to get the volume of activity you had at the top, a year or two ago. And then, when the bust hits, I think, at least in the States, you could see 35% hit to the prices. And, I know UK's got its issues. So, you guys will get hit too.
In that regard, do you think the US is less vulnerable or more vulnerable than the world outside? There should be a natural demand. We were speaking to a cycle expert, Phil Anderson. He was saying that because America is kind of the place to live, it will always have underlying demand for the dollar and for people to want to buy there in a crisis. Perhaps you could say with the UK law that that's one attractive element of living in the UK or having a business in the UK, but we're certainly not as pro-business as America is. And I've struggled to think why we just can't sort that out. But in any case, who do you think is going to weather the storm the best and the worst? If we could give a kind of
you guys need a Maggie Thatcher. That's what you need.
Maggie Thatcher.
But yeah, I think my thesis has been, in terms of the global bust, that because of what happened in 2008-9, our banks are in better shape than they were going into 2008-9. Obviously, we were forced to get religious subprime and all of that. So our banks are better capitalized this time around. That doesn't mean they're not vulnerable. They're vulnerable. But I think the European banks, the Canadian banks, the Australian banks, the Asian banks are probably where we're going to see the bigger problems this time. It'll spill over into the U.S. banks because it's obviously a small world, but I think it's very possible. From a financial standpoint, it's very possible that the EU is where the biggest troubles are. Maybe Asia, but EU's got. I think the banks are just more vulnerable.
Tim, I can keep asking questions. I just don't want
to. I think we both can. Talking about the EU reminds me of a joke made by Professor John Hearn, who said it's like 2050 and the EU will be long gone and it'll be like tumbleweed, and the UK will still be trying to furiously negotiate its way out.
Yeah, I mean, with regard to the euro, do you think this is masking a lot of problems within the euro area? And when they put the euro together, everything was going up. So you had a very stable, sunny outlook for the markets, and we're in a bull market. And of course, there's been big moves in between, but that was the environment. And there was so many countries that thought that they were going to get rid of their currency and were part of the euro, but they were also going to take the euro. Like Poland, for example, they were always going to take the euro. The Czech Republic didn't take it, but the Slovakia did take it, and there was a break on it when I think people saw the problems that it caused by kind of painting having one interest rate for very diverse economies. And they've managed to keep this together much longer than I actually thought it would ever last.
But at the expense of a functioning democracy, because you look at politics in Germany, and they're now trying to outlaw parties that they don't agree with. It's a real scandal.
Yeah, it's when you look, basically you take away countries' ability to respond to their economic crises. Spain, Italy, wherever. Everything's kind of driven by what the EU wants and what the ECB wants to do, and it takes away your flexibility. I think as the bust hits and as things get rough, it's going to be hard to hold that together, I think. And especially when you look at the trends in the world. Obviously, Trump, Meloni,
Millet.
We are, and certainly France came close. We are seeing a move to sovereign nations again, a move back to saying, we want to get away from this globalist approach.
Mm. And what percentage, if that's kind of a fair way to put it, or feel free to ignore it if you think it isn't. Of what percentage chance do you think the euro would actually break up and people would go back to countries would go back to their 2.0 version of their previous currencies? Because I think they're not allowed to. So the Italians can't go back to the lira, but they could call it something similar.
New lira.
It's always hard. It's always hard to imagine something as big as that, right? But if I'm right about the global bust, I think the odds are a lot greater than you might think that the euro's not going to survive.
I'd say this is a problem caused by the EU itself, because I remember back in the day, back in the 90s, working at Paribas and trading in ECU bonds. If either of you guys remember the ECU.
ECU, yes.
And the problem is with the whole EU fantasy economics is there was never ever a plan B. It was always assumed it would be this sort of monolithic, currency that would never ever need an escape route. And if you've got that degree of hubris, you are guaranteed to have problems at the end of the day.
Sure. Yep. And you talk about bureaucracy. I mean, you just don't, when things start getting rocky, you don't need the bureaucracy in the way saying, we're going to hold this together and we can't do this and you can't do that. I mean, I just think people are fed up with it. So, the bureaucrats may be able to hold it together, but I think there's a higher percentage than you might think of things breaking apart.
When the euro was put together, one of the arguments was, look at America and look at how well the states work. But the thing is, Americans feel like they're Americans. There is no,
and they have a 200-year history of integration.
There's no desire for Germans to want to pay Greek pensions, and vice versa, and so that doesn't make sense. And I think on top of that, as you were also alluding to, the cycles seem to be suggesting that people are, even within the states in America, as we saw through the pandemic, there were different responses, and it's almost like there's more fragmentation out there than there is a desire to unify, and those things go through trends as well.
Yeah, I think it's a trend in the right direction. It's very good news that we're moving back towards individualism, back towards sovereignty, and away from globalism. And I think that's at all levels.
Do you think that do you think there's do you think there's a chance of civil war in America, given how fractured the two sides seem to be?
I thought there was more of a chance of that before Trump got elected. I mean, he's going to town, and I think I don't know what the numbers are, maybe 55% versus 45 now. But I mean, it used to be, the MAGA side was 30% or whatever. I think an awful lot of people in the last year have moved over to saying, yeah, this, we're starting to see the light. We see the media was lying to us. We see the Democrats were all about themselves and trying to basically, if Trump, we dodged the bullet. If Trump had not gotten elected, I think we were looking at a one-party system in the U.S. I mean, it was that far along that if they had, I mean, the lawfare and everything that was going on, they really truly were destroying this country and what we stood for. And I think doesn't mean we're out of the woods or that this is a long trend that's totally we've reversed this and it's going to stay like this going forward. Who knows? But I think Trump was an important election, probably the most important election in my lifetime, more so than even Ronald Reagan. And the left isn't going away quietly, but I think Trump and his team have thought this out. They're not coming in like they did the first time and not having a plan.
It wouldn't be a fair fight if you had a civil war now, because all you'd need to do to demolish the left would just be to deliberately misgender them, and they would just collapse spontaneously.
So value stocks are coming into favor. Do you think that this is something that will transcend the crash? So will be a good move into and beyond the crash?
Yeah, if you think about what my bigger picture long call is, it's basically rates down here. So it'll, I think this last move, what I call the final parabolic move into a top, will probably be broadly based. So both growth and value will play, both large cap and small cap will play because you're going to have rates moving down. That'll benefit growth, but you also have with the move towards small cap, the move towards things. It's unusual. Typically, in a final move to a top, markets narrow, right? Normally, you narrow into a very narrow group of stocks like the Nifty 50 back in '73. But I've said for a while that I think this last leg of this one's going to be a broader move, and it's because of that. Because I think bonds are going to play, so that helps growth. But also the economy is going to be intact, and the earnings are going to be intact, so that helps value. And you're also getting, I think, the Fed will be. You'll have wind at your back. The Feds will be easing because inflation is moving towards that 2% target, and as a result, people start looking over the trough and saying, okay, the cyclicals can play. So I think you get that into the top, and then you get the bust and what I'm calling an 80% bear market in the bust. And coming out the other side in the next recovery cycle, I think it will be value will lead. It'll be basically a very big industrial / commodity cycle. And if you think about what the bust is going to do, it's going to hit housing hard. It's going to hit stock holders hard. So the wealth effect is going to get driven to the floor. The consumer is not going to be the driving element of the next cycle. If the market drops 80%, you can have the S&P triple or quadruple coming out of that. So a cyclical bull market, but it won't get back to the highs of this year. So if let's say we top out at 7,500 and you drop 80%, that's 1,500. And again, I'm not trying to say it's going to precisely do this, but and so you could go 1,500 to 6,000, which would be a quadruple, and you're still short of 7,500 by quite a bit. So I think we're at a secular bull market peak. The start of the secular bull market was 1982. It was driven by disinflation through most of that 40-year period. And the next cycle is going to be more like the late 70s. It's going to be, oil could go to $500 between, I think oil's going to 30 in the bust. From 30, it could go to $500 by the early 2030s. You're going to have inflation. That's going to put a real crimp in the lifestyle of the consumer. He's going to be just trying to get by. So the real strength of the market in the post-bust era is going to be industrials. It's going to be commodities. And of course, what we've done is for 20 or 30 years, we've rationalized capacity in commodities down, right? It was not a commodity world. We kept shrinking commodities and made them more efficient. And then all of a sudden you get this 20 trillion from the Fed and proportionally similar from every central bank in the world to deal with the bust. You will ramp up demand in a hurry, a couple year lag maybe, but by 27 or 28, demand for commodities is going to be through the roof. You can't ramp up capacity. You've shrunk the capacity of the commodities down in copper and aluminum and steel and everything. And yet demand around the world is going to go through the roof, particularly in the US as we reshore. The only thing it can give in a period where you have limited capacity and huge demand ramp up is price, and price goes through the roof. So you get a few years where commodities make money hand over fist, but it doesn't last because the central banks can't print more money. They're going to be tightening, trying to deal with this. So you get a short cycle. I'm guessing the cycle will be over by the 2031 or something like that. So you come out of it, let's say in 26, second half of 26, and you're done by 2031 or something like that. It's a short cycle. If you're in the right places, you can make a whole lot of money, but it doesn't mean it's across the board. There'll be places in tech, obviously, with AI and things where there'll be growth through the roof in certain areas, so they can make it. But it won't be a tech cycle like we had this time, where rates were generally trending down through most of the tech cycle, and growth was moving up. In the next cycle, it's going to be very much a cyclical growth driven by price.
That's partly suggested if that comes to pass, which is certainly a view I'd be sympathetic towards, then maybe the commodity-based emerging markets will outperform the G7.
Absolutely. I think Australia, Canada, and probably Africa and places like that should do very well. As well as, I mean, if oil can go from 30 to 500, obviously there's going to be an awful lot of money made in plenty of places where oil is prevalent.
Mm.
In after the 1929 crash, the sentiment was so negative on owning stocks that people just were revulsed by it. They did not want to own stocks at all. It was considered to be something that you just wouldn't touch anymore, which is so alien to how we see the market now. And what you're describing, I think, would be that event that would make people go back to feeling that way potentially, because as we know, these things all go in cycles, and people who've grown up with low inflation didn't think that or grew up with inflation didn't think that interest rates could go negative. That was considered to be impossible. As soon as people start saying things are impossible, you just, as you say, look back in history, you can see what's happened before, and so it is fascinating, and if not a little scary, of course, if you're on the wrong side of it, as to what might be coming. And if we're going to see an 80% drop, and the market's not going to be able to get back to the previous highs for a considerable period of time, with very high inflation, high interest rates to try and combat that, which is not going to work, it's going to completely change people's outlook on long-term investing.
Yeah, think about three implications of what I just described in terms of what I think is coming after the bust. One is, as I said before, you'd be nuts to own a long bond, right? You don't want anything of duration in a period where inflation goes from negative inflation, deflation in the bust, to potentially 20% plus inflation. So, and interest rates followed that inflation. So bonds as an investment will become, there'll be a lot of people that are slow to recognize it and lose a lot of money, but really you won't want to be in long duration bonds for the balance of the decade, generally anyway. It also, is a time when you won't want, you go back to the mid 80s, when the financial industry figured it out. They said, we got this rat going through the snake. The baby boomers, they dominated trends from the late 60s on, because they were such a big population group. And they figured out in the mid 80s that it was financial assets are going to be accumulated, that they were at the age where they had bought their houses, they had bought their furniture and their appliances, etc. And now they were starting to think about retirement and accumulating assets. So from about the mid 80s on, and I was there, I was running money, the financial industry figured out the whole mantra of it's time in the market, not timing the market, right? And it's a matter of accumulating assets. Just buy index funds. You don't have to pick stocks. It's no more churn them and burn them. We're going to put you in an index fund where you don't have to be a genius. You just go along with the trend. And frankly, anybody that listened to that in the mid 80s and did that has been rewarded tremendously, because the indexes were hard to outperform. Most active managers underperformed the indexes for much of that time. Going forward after the bust, and don't forget what drove the stock market from the lower left to the upper right was primarily two things. You had growth, you had steady growth, not inflationary growth, but steady growth, and you had interest rates trending down from high double digits down to almost zero in 2020, right? So you had PE multiples expanding. They're the inverse of interest rates. So you had PE multiples go from single digits in the earlier 80s to mid 20s, and so that's been great for index funds. The post bust era is going to be the exact opposite, where rates go through the roof, PE multiples get squeezed, you go back to single digit multiples, ultimately, if rates go that high. And so, in other words, it won't be the same game. You can't just say, well, I'm buying an index that served me well for 20 years or 30 years. I'm going, I'm going to do that again. You're going to see active management is going to be a far more important component of investing post bust. So that's a second implication. And then the third implication, which is a big one, that if you think this through, it's the fact that the central banks are going to be taken out of the game. The reason we've allowed the music to continue playing for 30, 40, 50, 60 years is because we had central banks constantly expanding their balance sheets, right? Constantly coming to the rescue when the cycle turned south, they'd come back in. When excesses got there, they tighten up and bring us into a recession. If you're going to have high double-digit inflation, high double-digit interest rates, you can't be printing money, and yet we're going to have budget deficits and debt that has to be serviced. We're not going to have, they're not going to be able to. MMT, which I always said was a fraud anyway, was a ridiculous thing. Doesn't work in inflation. You can't print money into a high inflation environment because it's like pouring gasoline on a California forest fire. You're going to have the equivalent of the Santa Ana winds and the biggest roaring forest fires you ever had, and you can't say, okay, but we're going to pour more, put more wind and gasoline in there, so I think it takes the central banks out of the game.
So they become impotent effectively, rather than
basically they can't do anything. And that's when the music truly stops with a lag. It takes time, but because the only thing that's kept standard of living's kind of moving forward in spite of all the mess out there is they just constantly were printing money, and it was two things. It was central bank printing, and it was government expansion. I mean, fiscal expansion. So we'll have one last hurrah of that coming out of the bust or in response to the bust. After that, that game's over.
You were talking earlier about both of you about changes in behavior as a result of the 29 crash and then the Great Depression. If what I think we're all furiously kind of agreeing with ourselves about comes to pass this time around, that also, in addition to an aversion to stocks, something else that would likely occur is an aversion to leverage, an aversion to debt, which would be completely transformative to the world we live in now. So it would have implications for the banking system, and therefore I'm thinking for basically the primacy of the US, and also to a lesser extent the primacy of something like the City of London. So it'd be a much more multipolar world, wouldn't it?
Yeah, unfortunately, what I think happens here is we have these things are going to happen in such a big fashion. In other words, you're going to have the melt up into a top is one big thing, and then you're going to go through this crash or this bust, and then you're going to print your money way out of it and have one last big inflation cycle, and then a collapse. That unfortunately, I don't know that there are any real trends within that other than for a couple of years. In other words, the macro just trumps everything, and the policymakers are going to be chasing their tail.
Hmm. I mean, one thing Russell Napier's argued for quite some time about is the rising likelihood of financial repression. and it's difficult for that. It's difficult not to see that happening in terms of, say, pension funds being forced to own either U.S. Treasuries or UK government debt, and as the sort of buyer of last resort.
Yeah, I just like I said, because I think by the mid 2030s we get the next depression, and it's far, far bigger than the 1930s because of the massive financial um, mountain. We have we're going to have probably 450 to 500 million in global trillion in global debt. You're going to have inflation that leads to deflation. There's going to be a collapse of this, I think, the system, basically. And what comes out of the ashes of that is very hard to imagine.
So your oil call is one that has been outstanding, because you've been bearish since $120, and you've consistently said that it will go lower, and it had a little blip, but nothing that was substantial, nothing to change that. You're still looking for 60 and then 30, I think you said.
Absolutely.
So what is it's such an outlier of a call. What is behind that thinking? Because one would normally assume that if, look, the economy's doing well and copper's going higher, so there's demand, and there's demand for other resources. Why not demand for oil?
Yeah, it basically is the idea that we people think we are in a stronger economic environment globally than we really are. And again, it goes back to that pandemic statement I made, where I think underneath the surface, things aren't all so good. We kind of hit a lot of it with money. We printed our way out of it so that we didn't stay down long. And again, I say we, but it's really around the world. And I think below the surface, we really don't have the kind of demand that you would think we have based on statistical GDP, et cetera. And I think that, energy is basically, the supply demand of energy is still skewed to the fact that there was excess supply. And yet that was not how people were perceiving it. Everybody was perceiving it as energy is tight and prices have to go up. And I just didn't see that. And it's been borne out, I think. So, and part of that, I'm sure, is, the whole focus on alternative energy, et cetera, kind of took people away from really a true focus on fossil fuels in the way they, analysis wise, the way they should have. I do, obviously, probably goes without saying, but I do think, this idea that fossil fuels are on the way out is obviously at least one cycle premature, and probably more than that. I think we're going to see fossil fuels be one of the big lead stories of the balance of the decade after we get through the bust.
We were supposed to run out of oil in 2000, I remember.
Right.
When I was at school.
What,
and it's like
what you will see, and probably Trump will help this along, is you will see, I think there's going to be drilling in the Anwar. I think there's going to be drilling in the Gulf of America. And, he's renamed it because Biden tried to stop any drilling in the Gulf of Mexico. So, documents all say Gulf of Mexico, so they just changed the name to Gulf of America, and it can go forward. I think I don't know the legalities, but that's I think you're going to see, obviously, off the coast of South America. There's big oil fields there. I think you're going to see a lot of the offshore drilling pick up speed. Obviously, if you get prices going where I think they're going to go before the end of this decade, it opens up a lot of places that aren't viable at $70 oil. And so I think fossil fuels will be a big story.
It's funny. I saw a piece about Brexit that someone had written on Substack recently. It was very good, and it reminded me of just how much insanity we lived through in the years immediately after 2016 that I'd completely forgotten, and not this as a complete betrayal of the UK electorate by the Uniparty, whether it was Conservatives or Labour, didn't make any difference. And I'm wondering whether something similar will happen in relation to Biden, that people will look back in a little while and think, I can't believe that happened while we were alive. this
Yeah,
complete abject insanity, this Marxist woke LGBTQ plus, it's
yep,
just staggering,
it is.
absolutely staggering. Like everyone was under some kind of a spell.
Well, it is. It really is some kind of a statement on how, that's why I'm a contrarian, but how for the vast majority of people, they have to be with the crowd, and now we got a new sheriff in town, and the agenda is very different, and a chunk of that crowd is already moving over. It's like, how can you be 180 degrees over to the other side after being where you were? It just is. I think it's another look into crowd psychology.
I mean, Google at one point had a tagline, "Don't be evil," and I noticed they quietly dropped that. So I'm assuming that the tagline is now is be as evil as possible.
Right. Yep.
I was looking at some statistics on the amount of children that people in the West are having in terms of the more industrialized their economies are, the less children they're having. And it's something that is not going to be a problem now. It's going to be a problem further down the
Yeah.
curve.
Yep.
Do you have any opinions on that?
Well, I often get people asking whether demographics is part of my forecast, and I go, not at all, really. The macro is so dominant right now. What the big swings that we're going to have are so dominant. I don't really worry about the demographics, but I think the demographics fit into the same scenario pretty much.
Yeah.
The fourth turning and all of that I think fits in, and yet none of my forecast comes from that at all.
Yeah, it was almost something that it kind of plays into exactly what you're saying, that this will be one of those other left field things that people haven't thought of, and then afterwards go, oh, actually, this is why we can't we don't have we don't have, for want of a better words, young taxpayers, and a vibrant younger economy in order to grow our way out of this problem. So
Yep.
it is a problem for, a decade perhaps in the future, but it is not nonetheless an issue. And given that we are presiding over potentially, I mean, you've got 50 years experience in the market plus, and Tim and I have got about 30, which is obviously a lot less than you. But we've seen some swings in our time, and we're actually coming to a point where we're potentially seeing the biggest swings of our lives coming up. Are you being asked to manage money? How are you personally going to be dealing with what's coming? I mean, you're very generous on Twitter. You answer lots of questions all day long, and I'm sure you don't have to do that, but you do it. What are your plans for dealing with this very volatile period coming up?
Yeah, I made the decision several years ago that I thought I could, I'm basically retired in a lot of ways. This I spend an awful lot of time doing this, but
You seem to be working hard for someone who's
but
retired.
but I made the decision that there was a place to educate the masses, thanks to Twitter, thanks to X, and that I could have an impact on a group of people that really have no idea what they're doing and get kind of swung around by all the noise out there. And that if I could get a platform and show, basically be that contrarian voice out there, that alternative voice, that they could at least begin to understand that just because the biggest voice says this is so, it's not necessarily so. And I've being up to 212,000 followers. It's a small. I'm a big fish in a small pond. I'm not impacting as many people as I probably could in other ways, but there are a lot of little guys that I think I've helped.
But
To
especially given the collapse of trust in mainstream legacy media now.
Yep, yep. And I, most of my focus, as you guys see, is financial, but I am not afraid and wasn't afraid when Trump was running to speak out about the, provide the conservative voice to speak out against what I thought was a lot of wrongheaded stuff out there in the media. And I think that's a necessary thing out on social media. There's an awful lot of stuff out there that's just wrongheaded. So that's, between these interviews and Twitter, I think I reach a lot of people. Not all of them are followers, or a lot of them. I don't really know how X works, but there's an awful. I can promise you, there's an awful lot of, because I see, I can spot. I've done this for so long, and I know my views, and know how unique some of my stuff is. Not all of it, but I can spot when other institutional people are out there mimicking what I said, and they don't, almost never do they attribute it to somebody else. They want to say they thought of this or whatever, but it's pretty easy to spot some of my extreme views. And so I know there are people on Wall Street that follow me, even if they don't admit it, so it's, keeps me busy in retirement.
So when are you going to launch Hunter Coin?
Yeah, people keep waiting for me to get on board of Bitcoin, and I go, I'm just not there. Let's see what the bus does.
Have you thought about a Substack, or is it you do a letter though, don't you? So you do is that a monthly letter? Or?
I do a quarterly letter.
Quarterly.
Okay. And I've got a decent subscriber group, but I could be a lot bigger if I wanted to be. But again, I really believe in balancing my life. I want to have time for my grandkids, and not just kind of put them off in a corner and say, when I have time, I'll get to you guys. So it's I'm comfortable doing what I'm doing and not looking to expand it.
Great. You got your priorities absolutely right there, it seems. Tim, were there any final questions?
Nothing to add. We've covered an awful lot of ground today.
Yes, absolutely. So at this point, David, was there anything that we hadn't asked you that you wanted to say to people?
The only thing, and I think we've talked about it a little bit, but I've said this before in interviews, psychology is such that it's easy to say, if this is we're within final months of a 42-year secular bull market. Ordinarily, wisdom would tell you you're not going to be smart enough to call the top, and so you got to kind of start understanding there's big risks on the other side of the mountain. So don't be afraid to take chips off the table, etc. The only thing that makes this a bit different is that we are probably going to cover an awful lot of ground in that last small period of time. So whether it's 3 months or 6 months or 4 months or what, we could have 25% from here in the NASDAQ and the S&P and Dow, and closer to 45 or 50% in the Russell between now and the top. So you have to look at both of those things, time and distance, and understand 25% is, easily 2 or 3 years worth of returns, and 45 or 50% is, more years of returns than that. So it's hard to say, just look at the fact you're getting closer and you should, be smart and get off and take the chips off the table. And psychology is such that understand that you could get out today and feel pretty good and say, I can't call even the last 20%. I'm not that smart. The psychology is going to drive you back in at the top. Chances are you're going to say, gee, I left too much on the table, and now I'm hearing that this cycle might go on for a few years. I can't afford to be out. I'm getting back in. You get in at the top. So just don't outsmart yourself and think that, because there's going to be lots of people out there telling you not to play it too close, not to, and it's just psychology is going to make it, no matter what you do, it's going to be hard to do it right.
Yeah. It's hard for a reason, isn't it? That's the thing about markets. If it was sort of naturally easy, everyone would just make money, and it just doesn't work like that.
What people don't realize is at the top, I can talk about the top and how it's going to be, I'll be spotting it because so many people are all in. At the top, there's going to be a compelling reason why people are in, and it's going to be hard to fight that.
Yeah, absolutely, absolutely. Um, so I asked you about your reading last time, and you recommended David Dreaman's book on contra investing, and I read it. Fantastic. I really enjoyed it. I thought it was excellent, and it gave me a really good insight into perhaps how you were thinking about things. There's also another book that I think not on our pod, but you recommended a book about bond yields. Is that correct?
Yeah, there's a book called Inside the Yield Curve, or Inside the Yield Book, um, by Leibowitz and Homer, and that was when I did my CFA back in 1980. That was required reading. It was, basically any bond guy has read that, I'm sure. It takes apart the bond, teaches you the yield side of it, components of the bond, et cetera, teach you how interest rates work, et cetera. It's a great primer for anybody who wants to learn more about bonds.
And do you think that this will be it will stand the test of time through what we're about to see, or will the,
Yeah, because it's
yeah?
not really about trying to call interest rates or anything. It's really about how bonds work.
So it's all about the mechanics, and once you
Yep.
understand the mechanics, you understand what's going to come. Okay,
Yep.
brilliant. Are there any other books that you?
I'm gonna go off in a different direction, non-finance.
Okay, cool.
I haven't finished the book yet. I was well aware of it for a long time. Um, I My daughter got very sick with Lyme disease
Oh no.
back in 2000. She was finishing eighth grade. She was the top student in her school and top athlete, Olympic development soccer player, which meant youth soccer at the top of the state, and was all excited, ready to, probably be a 4-year starter in college, in high school. And, she played softball, played basketball. She played cello. She played piano, was very good at piano, um, and had everything going for her, and got diagnosed with Lyme. Her last half of her eighth grade year, we just knew something wasn't quite right. She got diagnosed with Lyme disease, and I thought, oh, great. We lived in Connecticut, which is kind of epicenter of Lyme. I thought, oh, great, that's something you just take some antibiotics, should be good as new.
Mm.
She missed high school. She missed 5 years of school. Took took 6 courses in 5 years. Three, she missed freshman year, went back as a freshman the next year. Um, taking 3 honors courses, and barely, she was a, hard driving, self starter. So she worked her butt off and was top of her class, but she'd come home collapsing. So all she could do was those 3 classes. Um, and halfway through the year, brain closed up. She had to drop school altogether, and for 3 years couldn't read. She'd go, I can read this, Dad, but I can't comprehend what's going on. Um, so then those 3 classes, she had the teachers of those 3 classes, or two of the teachers and one the tutor, finished them up 3 years later, and then was tutored in English, or we kept her 5th year for services. She ended up scoring very high on her SATs, and got a presidential scholarship, went to college. Because of it, you got a GED. Because of a GED, she was 1 year behind her class, graduated a year behind her normal schedule, even though she missed 5 years of school. So she came back from it. But it's as a result of her, I got involved in Connecticut in Lyme and started learning about it and learning. It's a very political disease, very political. And it's worldwide. It's known in New England. It's very predominant disease, and it comes through ticks, a bite of a tick. Um, it's usually accompanied. She had a couple of co-infections accompanied by other infections. It is, millions of people are being struck down by it. The government has done a very poor job. I'm looking forward to RFK Jr. getting in, because our CDC and NIH, et cetera, have done a disservice to the American population in terms of covering up a lot and putting out misinformation, et cetera. In Infectious Disease Society of America, who has the guidelines for Lyme, they're very inadequate, purposely inadequate. So I've known, from the year 2000 and since. There was a book out in 2004 called Lab 257. It was a lab off the coast of Connecticut in Long Island Sound that was a level 4 bio lab. they worked with Lyme and other things, weaponizing these things, and it escaped from the lab
Shit.
and ended up, deer would swim across the sound and bring the ticks on land, etc. So, starting in the early 80s, it started cropping up places, and, it got named Lyme disease because it showed up in Lyme, Connecticut. Um, but it's Borrelia burgdorferi, is a spirochetal infection. If you know what a spirochetal infection is, another one is syphilis. So it can get to the brain. It can change forms and hide out in the body. It's very hard to treat. It causes a lot of neuropsych issues. It causes a lot of arthritic issues and skeletal issues, etc. It's highly debilitating. It's very big over in Germany near the Black Forest. Anyway, long story short, there's a book that came out a few years ago by a woman named Chris Newby. She had contracted Lyme when she was on Martha's Vineyard. She's from California, but had contracted Lyme when she and her husband were on Martha's Vineyard back in the 80s, I think. And she goes through her story, but she also did a documentary along the way, which I was privy to back in the early 2000s. They came to a conference we were leading on Lyme in Connecticut, had the CDC there, et cetera, but they showed up because they were doing a documentary and wanted to interview people. This documentary was called Under Our Skin, so a tick bite under our skin, Anyway, she interviewed in that documentary a Swiss scientist. He was a U.S. citizen by then, but had come from Switzerland. He worked in our Rocky Mountain laboratories out in Montana on ticks, was part of our biological warfare program, and was very close to the vest on a lot of stuff. On his deathbed, and actually, Borrelia burgdorferi is the name of the bacteria of Lyme. This guy was Willy Burgdorfer, so it was named after him because he was a researcher that discovered back in the 80s that Lyme disease was being caused by this bacteria, because he was dissecting ticks and came up with it. Well, Chris Newby, who did this documentary with another guy, really good documentary, but went back and interviewed Willy Burgdorfer years later. And there's a book called Bitten that came out a few years ago. It really exposes these tick-borne disease, particularly Lyme disease, as a biowarfare weapon, weaponized bacteria, and what it's done. I mean, it's responsible for millions upon millions of people's mental illness.
Wow.
And nobody knows it. I mean, so I would recommend the book Bitten. I'm only halfway through it, but it rings so true to me because of what I've lived for so many years with this disease. And Lyme can be, if caught early, can be treated successfully, et cetera. But I ran a sport group, still run a sport group, started in 2004, ran one in Connecticut, came up to New Hampshire, run one here. And I've helped thousands of people through what is just a very debilitating illness. And, only a small cadre of doctors know how to properly treat it. Most of the medical community has been told that it's a simple illness. It's not a big deal. And 3 weeks of antibiotics takes care of it. And that's all false.
How is she now?
She's got 3 boys. My 3 grandsons with her are 5, 9, and 11. Healthy, active boys. They hike, they ski, and she does. They kayak and do a lot of outdoor stuff. She still suffers, and since COVID, when you get long COVID, it's really reactivation of the Lyme. So when she gets hit with any illness, she's down for the count for a couple of weeks. It hits her hard. It comes with a lot of debilitating fatigue. It comes with the brain functioning sometimes and being foggy other times and stuff. So she's learned to live with it. But as she says, Dad, more than 2/3 of my life's been with this, so I don't know what normal is. It's sad because she's an example of what I think is true of so many. Our best and brightest were hit by this, and so she could be so much more than she is, but she's happy being a she's a great mom and home and able to do that. But it just it's really sad because there are a lot of people out there living lives of desperation. A lot of MS is Lyme disease, Lyme and co-infections or co-infection, but MS, Parkinson's, lupus, bipolar disease, even schizophrenia can come out of this.
Wow.
I mean, I can't tell you. It's as bad as it was. It's a blessing in terms of the knowledge I learned in the last 20 years because of having to fight the battle for her. The reason I went from institutional money manager to a sell side strategist was so I could stay home when she was sick.
Right.
So my career that I loved, half of my career was money management, but this gave me the opportunity I could work from home and do it. So, um,
Yeah.
but so anyway, bitten by Chris Newby.
Yeah. I remember seeing a documentary, and I don't know how valid this is, but they were using bee stings in order to try and have you seen that?
Yeah, there are people that have had success with that. It's tricky, and some people have tried it and it hasn't helped them, or they couldn't do it, or whatever. But yeah, there's a lot of alternative treatments people have tried to beat this, and certainly lots of people have overcome it. But there's millions of people living desperate lives that don't realize what either don't rather realize or realize but can't get past it. It
Yeah.
really is tough to treat.
Yeah. Well, let's hope they come out with some kind of cure very soon. It seems like um, the more we can bring this to light, the more people can benefit from it. So it's a really important thing that you've done.
Yeah, and
Bring
I
it
can't
up.
stress there is UK has is dealing with this. The
Yeah.
Scandinavian countries are dealing with it. Germany and Russia certainly. I have heard that the Black Forest is an area that's loaded with this stuff. So
You have to be very careful if you go walking and there's you're showing any skin in the woods. If you get a tick, you mustn't pull it out because it will leave its
yeah,
what
you can't squeeze it or you're going
can't
to send the
squeeze it
blood spewing into your bloodstream.
exactly.
There are ways to take it out
You
carefully,
have to
but
twist it, but you've
yeah,
got to
you
look
kind
it
of
up. Yeah,
if you have tweezers, you grab it at the head, right at the skin level, and pull it out slowly. You can't yank it or it'll let go. But I mean, let the stuff go. But
you can put
um,
soap on it. Apparently, that works as well. If you put soap, it can't breathe, and then it lets
no,
go.
that's a myth. Yeah, that's one of the things that can irritate the tick so that it will release its guts.
Hmm.
The spirochete is in the guts of the tick. So if you irritate the tick by putting soap on it, it'll let go and send it into your bloodstream. So
Yeah.
unfortunately, that is out there. Everybody talks about that, but it's a myth. Don't do that.
Well, I think my daughter had one, and they did that with her. So we better not do that again.
Yeah, I mean,
Um,
it doesn't always happen that way, but just it's a
yeah.
risk.
Well, they don't all have the disease, so you could be lucky, and it's if you've got one that has it.
Absolutely,
Yeah,
absolutely.
yeah, yeah. Wow. Okay. That is one. Tim, what have you got for us?
Well, I'm hesitant to follow in the footsteps of that one because it's quite a serious one. So mine, needless to say, is ridiculous by way of comparison. So mine is documentary film called "This Is the Tom Green Documentary," which has just come out. I think we saw it. We saw it, I think, on Netflix, either Prime or Netflix. But Tom Green, for those people who aren't familiar, I only know Tom Green from a cameo in a very funny cameo in a very funny film called Road Trip. But Tom Green, Canadian, slightly madcap comedian, got his start in local broadcasting in Canada, and then uh, I think he got a gig on MTV. Got his own show, then was diagnosed with testicular cancer. At one point, was married to Drew Barrymore. Have you
Right.
heard any of this, Paul? Are you familiar
Um,
with any of this?
I reckon I didn't know that, but I know a film I quite like that's unpopular is Charlie's Angels, the two original ones. I thought they're fantastic, great fun films, and he appears in I think the second one.
That would explain why, because obviously Drew Barrymore's in it as well. But the film he's most well linked with is Freddy Got Fingered, which is almost impossible to find So it's not on the major platforms, and I suspect it's an acquired taste. But anyhow, if you want to get a sort of summary of his career, because he's retired now and he's gone to live in the country, but this is a Tom Green documentary, and for those people who like, I suppose, Python-esque type stand-up, it's for them, but it's not for everybody.
Great. No, that's a really interesting one, Tim. Thank you. And so mine is this book called The Trading Game, which is by a guy called Gary Stevenson. I saw a YouTube video that came up on my feed where he was talking about his time working for Citibank, and it was a rags to riches story. And he's a fascinating character, and he's talking about how, you know, he became the most profitable trader in the world at one point and seemed very down to earth, really smart guy. And I thought, well, yeah, I'm going to buy his book and hear his story. And apparently he tried to get out, and it's maybe a bit like The Godfather. I don't know what happened, so I'm going to have to read it to see. But it's I've read a little bit of the first part of it, and it's really interesting. So I'll put a link to his video as well, where you can hear him talk about his career and how he got a job from basically having absolutely nothing and no prospects into, you know, going to the LSE, learning economics there, and through sheer hard work, and then getting a job at Citibank. So David, thank you so much for coming on the show. Thank you for being so generous.
My pleasure.
And your calls, we will be following them closely. And for everyone who wants to hear more, you can go to @Dave H Contrarian. And as we say, over 200,000 followers there.
If people are interested in my letter, they can direct message me on X, and I'll send details. So.
Yeah, so you can sign up to a quarterly letter. That's via DM, via the. And I noticed on your Twitter, you've very cleverly put your picture and the actual correct title as well, at Dave H Contrarian in your picture. So if somebody tries to copy it, it's clearly going to be wrong if they copy that actual picture. There should be AI to sort this out. I can't believe that if somebody copies your picture and it's exactly the same, yet they've got like 2,000 followers, why the AI can't go, hang on a second. It's like,
I know. Yeah.
It's so obvious.
Yeah, that's the one part of X should be able to handle this, and they don't seem to be that interested in doing that. But by the way, I should say my letter is by subscription, so I don't want people to think it's a freebie. It's not. Right.
Absolutely. Well, thank you once again, David. And, we look forward to having you back.
Yeah. Thanks, Paul. Thanks, Tim. My pleasure.
Thanks, David.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.